Hey, Intro to Accounting, Mr. Roberts here, and today we're going to look at lessons 3.2 and 3.3. Now, the reason we're going to combine both of these lessons is because what we're doing is we're practicing journalizing in our general journal, but we've actually gone over all of these transactions in chapters 1 and 2. So, all those times that I said, make sure that you're practicing these, that you can know it, refer to that sheet, but make sure that at the same time you start seeing them and you can recognize them. It'll make your life so much easier. Well, all that hard work is going to start paying off now when we're looking at these same transactions. The only real difference is we are journalizing them. So let's jump in, because today we're going to look at transactions that affect prepaid, insurance, and supplies to start out, and then we'll get into some owner's equity. So the first thing that we have is paying cash for insurance. And if we look at this, remember, we have 4 different steps. But before we even take these 4 steps when we journalize, we need to start looking at our T accounts, and we need to take a step back and say, what's being affected in this what accounts are being affected in this transaction, and are they going up or down? So I really urge you, go ahead and write prepaid insurance on our T account, and then look at it and go, is it prepaid insurance going up or down? Well, it's going up. It's an asset. So it's going to go up, and it's going to go up by $900. And then we're going to write out cash, right? And from there we go, okay, is cash going up or down? It's going down. And how do we decrease an asset? We're going to decrease it on the credit side. So make sure that you are still writing out your T accounts, especially if you're having trouble figuring out how each account is going to be affected. Some of you guys are just going to rock this and you're going to know it right off the top of your head. You know, oh yeah, prepaid insurance, it's an asset, it's increasing, it gets debited. You can actually skip that T account section. That's what I would suggest if you just know it by heart. And that's one of the benefits of practicing so many times beforehand and really understanding those concepts. So wherever you are right now, make sure that you do a little self-reflection and tell yourself, okay, I might still need the T accounts, or I'm going to move on past that point. We're still all doing the same thing, looking at the transaction, what accounts are affected, are they going up or down? So here, we're paying cash for insurance. We know cash goes down and prepaid insurance goes up. First thing we do is we write the date. And on this one, we wrote the 3rd. You can see it's transaction number 5. So that means that that there must be some January transactions that already took place above. Because if it was the first transaction on the first page, we would write out January. Second step is we're going to figure out what account's being debited. Well, here it's going to be prepaid insurance. That's going to go up. So we write out our debited account. And then in our debit column, we write out the amount. It's going to increase for prepaid insurance. Then we write out our credited amount. It's going to be indented a little bit, but on our online working papers, we don't really have to worry about that. It does it for us. And then we write how much the account is going to be credited. The 4th step that we have is writing out the source document. And here, this is going to be a check, but checks are pre-numbered. So this is the 2nd check that we're writing, and it's going to be referred to as C2. Okay, so you can see here, check number 2. That's our first transaction. Once again, if you've already been practicing these transactions, it's a whole lot easier. Now we buy supplies on account. So we look at it, it's from January 5th. It's going to be memorandum number 1. We write out our T accounts and we go, okay, supplies is going to increase. That's an asset, so it increases on the debit side. Accounts payable is a liability. Accounts payable will increase because accounts payable is the account, and we're tracking how much we owe somebody else. Do we now owe somebody else more money or less? We owe them more. So that liability, we increase on the credit side. So we go through our 4 steps. We write in the date. Then we write in our debited amount, which is supplies here, which is going to go up by $220. We debit that account. Accounts payable, Canyon Office Supplies, will be credited. And since it's a liability, when we credit this, that means accounts payable is going up, and it's going up $220. What do we do at the end? Well, we're going to put in our source document under document number, and that's memorandum number 1, referred to as M1. So next, we're going to pay cash on account. So this is very similar to all the other transactions that we've done. We look at it, January 9th, we paid cash on account to Canyon Office Supplies. We write out our T accounts and we go, what's going to be affected? Well, I know that cash is going to be affected. It says I paid it. So cash is going to have to be credited. And then accounts payable, now that we are paying money that we owe to accounts payable, is that going to go up or down? Do we owe more money now or less money now that we gave some to Canyon Office Supplies? Well, we actually owe less money, so we need to bring that accounts payable down. How do we bring a liability down? Well, we debit it. So once we determine that, we go through our 4 steps. We write in the date, then we'll write in the account that's debited first, which is accounts payable. Write in that debit amount, and then paid cash on account is going to make cash go down. So we write in the credited account, which is cash, and we credit it the amount. And then the step number 4, we write in our source document, and here it's document number 3. This here goes into careers in accounting. We have little sections like this all the way through. This is a forensic accounting, which is an awesome job where you get to kind of look up, it could be fraud. It could be looking if people are hiding money somewhere, maybe if they've been not super truthful with the transactions. So kind of a nice, interesting job there if you're looking into getting, plugged into an accounting career. So that's 3-2, okay? Very, very short, very quick. What I'm going to do is I'm going to pop open 3-3 and talk about the concepts in 3-3 because they are very, very similar. The only thing that's different here is now we have some transactions that are going to affect our owner's equity and our asset accounts. And just like in chapter 2, some transactions might be easier or harder for us to figure out. And the ones that were most newly introduced were accounts that affected our revenues and our expenses, right? And also our draws. So here we're going to look at some of that. And we really just need to remember what are their normal account balances. Hopefully we've gotten to that because we've been working through it on the chapter 2 test. But if you need to refer back on any of these accounts, what their normal balance is, I'd probably assume that this is where you'd need to refer back to. So if the page loads for me here, it's just taking a little bit longer. So we're going to look at transactions that affect our owner's equity and then record sales and receipts of cash on account. So the first one that we have is received cash from sales. We draw up our T accounts and we say, all right, what 2 accounts are affected? Well, my cash is going to be affected and my sales is going to be affected. So here we know that if we receive cash from sales, cash is going to go up, right? It's going to go up the $1,100. So we go through our steps and cash will be increased. It'll be debited $1,100 and sales has a normal credit balance. So we need to increase sales here. How do we increase sales? We credit sales. So we go ahead and write in our credit account, which is sales. We credit that amount and then put in our source document. For sales, remember we're looking at calculator tape for this. So how do we write in calculator tape? Well, we're going to put in T and then the date. Okay, so tape number 10. That's what we would actually put in here. Okay, so that's received cash from sales. And the only reason I'm going through this a little bit quicker is because we have done all of these transactions. What is different about it now? We're taking it from a T account and we're putting it into our general journal. That's it. Okay, that's the only difference. So next, we sell services on account to Main Street. So what are the 2 accounts that are going to be affected? Accounts receivable and sales. Remember, there's no cash that's actually being exchanged here because we're selling our services on account. So account receivable being an asset is going to increase on the debit side, and then our sales having a normal credit account go up. Even when we sell something on account, our sales go up, and it has a normal credit balance, so we credit sales. We go through our 4 steps. We write in the date, then we write in our debit amount, and then our credit amount, which is sales in this case, and our source document, which this time is S1, which means it's a sales invoice. Remember, the sales invoice is going to tell Main Street Services when they have to pay, how much everything costs, and the quantity of their purchase that they had. So there we go. That's sold services on account. Next, we paid cash for an expense. And for this one, I would say that out of all the transactions that we're going to do, the expense is always the one that kind of gets people, because the expense has a normal debit balance, right? And when we have a normal debit balance on an expense that's normally on the right-hand side of the accounting equation, people go, wait, what? It's on the right-hand side. It increases on the credit side. No, it doesn't. It increases on the debit side, which in turn is going to affect our equity in the long run, okay? And you'll see how that all comes together by the end of the class. So we paid cash for an expense. We go, okay, what is actually being affected here? And we have 2 different ones. It says paid cash for communication bill, which is cell phone and internet. And then down here it says paid cash for equipment rental. So they're just going through 2 of them. What we need to ask ourselves, though, is what's affected? Well, expense is going to be affected, and my cash is going to be affected. If I pay cash for an expense, is cash going to go up or down? It's going down. It needs to be credited. What about expenses? Well, the increase in expense, we need to debit it. So if we go up to the top, that's exactly what we're going to do. We put in our date, then we put in our debit amount, which is going to be communication expense. Then we put in our cash amount, or our credit amount, which in this case is cash, and it will be credited. After that, we put in our source document. Here, they're just doing it twice, okay? These are 2 different transactions. When we look at it, please make sure that you remember that the accounting equation must balance. So our debits here equal our credits. You'll never have 2 debits. It won't happen. Okay, you'll never have 2 credits. It won't happen. Next, we received cash on account. Okay, what does this mean? It means that somebody that owed us money is now going to pay us, right? We issued that sale invoice. We said, you better pay us in 20 days. And now they have paid us within that time frame. So now we need to record this transaction. And you might be thinking, oh, that's a sale. Now remember, it's not a sale because we've already recorded this once as a sale when it initially occurred. Now what it is somebody paying us that money that they owe us. So if we're going to receive that cash, what happens to cash? It gets debited, it increases. Accounts receivable. Does Main Street now owe us more or less money? They owe us less money because they just paid us. So accounts receivable, being the asset that it is, gets credited, it decreases. And once again, we write in our date, then we write in our debited account, which is cash, and our credited account, which is accounts receivable. And then we put in our source document, which here is receipt number 2. Once again, you've done all these transactions. All we're doing now is placing them in our general journal. We're journalizing in the journal. The last one, paid cash to owner as a withdrawal of equity. Okay, paid cash to an owner as a withdrawal of equity. So what's happening here? Well, our owner is going to take that money out of the account because he's going to say, hey, the business is doing great. I'm going to make sure that I can go on vacation this year. So he's going in there and he's going to take some money out. So what happens to the cash in the business? It's going to go down. It's going to be credited. What about Michael Delgado's drawing? That needs to increase because that drawing account is once again an account that shows all the times that Michael Delgado withdrew money. So if he withdraws money 4 times, that account just keeps getting debited. It keeps showing that he took out more and more money. So it has a normal debit account. Michael Delgado's drawing is debited here. And you can see we go through the steps. We have our date. Now we have our debits, our credit, and then our source document. And we write a check to Mr. Delgado for this. So that's all the transactions, but really it's all the transactions we've had the entire time and we've been working through, right? We've been looking at each one of these transactions. Now we're just making them entries by journalizing them in our general journal. Okay, so let's take a look at the work together and on your owns for these two units. All right, so jumping into the working papers 432, let's go ahead and move our transactions over here. And it says Norman Dirks owns Dirks Copy Center using the information provided. Journalize each transaction, continuing on the next blank line of page 1 of the journal. Source documents are abbreviated as follows. Check is C, memorandum is M, memorandum. All right, so this work together is still working on the same page from 3.1. So we're adding more transactions. First thing I do is I'm going to put in my date. It's going to be the April 5th. Next, I look and I say, okay, what's happening with these accounts? I bought supplies on account from Supply Mart. So I know supplies is going to go up, right? If you have to draw out your T accounts, go ahead and do that. But we draw out our T account, we say supplies has to go up here and it increases on the debit side. So I know right away that supplies is going to increase on the debit side. And what's the other account that's going to be affected? On account. So we bought supplies on account. So that means my accounts payable is going to have to increase. So I look here and it's called accounts payable Supply Mart when I go into my chart of accounts. Let's go in here, accounts payable Supply Mart. And my accounts payable is a liability. I need to increase that because I owe them more money and I increase liabilities on the credit side. Last step that I have is my source document and it's going to be memorandum, so M1. Moving on to the next transaction, we have the 7th. It says paid cash for insurance. Let's go to my chart of accounts because I think I'm going to get more prepaid insurance. And that's what the account is called. So prepaid insurance is an asset and I'm going to increase it because I'm buying an asset, which is, our prepaid insurance here. And it's going to increase by $500. What's going to happen to cash? It's going to get credited. It's going to go down $500. I'll put in my source document. That's going to be C2. So next, I'm going to put in the 9th, and now I'm going to pay cash on account to Supply Mart. Okay, so when I look at this, that means that accounts payable is going to be my first account because this accounts payable is going to go down. And how do I decrease an accounts payable liability? I must debit it. Okay, because the normal balance is the credit side for a liability. So I go in here and I'll put $300 as a debit. Now, just for an example, I know that cash is affected here, but what if I just type in supplies? Okay. Now it doesn't show up as wrong. Why does it not show up as wrong? And I know we've covered this before, but I just want to go over it one more time because this is a possible account. So you really need to make sure that you're writing in the correct thing. Sometimes people do this, right? They type in cash and they're like, oh, it's going to tell me if it's wrong every time I don't have the exact answer in there. The only reason that this is saying it's wrong is because it's no possible account at all. There's no account here that's CSH. Okay, so I just want you guys to know that as you continue on through this, because sometimes you might put in something that's wrong and you say, well, it never told me it was wrong. It's not going to necessarily just tell you it's wrong. It's going to tell you if you have a spelling mistake, but you do need to make sure that you have the right account in here. So let's credit cash, that 300. It looks like it's going to be C3. So let's save and continue. And we're just going to submit this. You please don't submit it. I'm going to submit it to make sure that we have it right. And there we go, 3 out of 3. So our work together and on your own for 3-2, that is exactly what it is, okay? Same thing. So let's go back and we will open up the application problem real quick. I just want to show you guys that the application problem is the same thing. So as you can see, the application problem is going to be the exact same thing, except it's just more transactions, okay? So that's all that's different, is there's more transactions to write in. So now that you know how to do 3-2, we're gonna continue on to 3-4 because it's all journalizing. We're just looking at different transactions, and you guys have already seen these transactions. So let's make our way to 3-4 work together. Okay, so here we are on 3-3 work together. Let's move our transactions a little bit here. And we have Norma Dirks Copy Center using information, fill out the same. We're doing the same thing. We're journalizing, okay? Now, it does get a little bit longer because they're assuming that we can kind of move through these a little bit faster. So let's run through these transactions, and these are going to affect our owner's equity. So we already have April listed up top here, April 1st. So all we need to do is put in the date of the 12th. And it says paid cash for rent. Once again, take your time, look at the transaction sheets if you still need to. I would suggest looking at the transaction sheets, writing out your T accounts, and then actually entering in these transactions. Remember, they're permanent. So in real life, you'd be writing these in pen. You want to make sure that you understand them and that you're confident in it. So the first one, paid cash for rent. So what we have here is two different accounts. One of them we know is going to be cash, and the other one, it looks like we're paying cash for something, but rent's not an asset. So let's go down into our expenses, and there we go. We have rent expense. That's going to be the account that we're looking at. Now, an expense account, we need to track how much we're spending in that expense account. So an expense has a normal debit balance. We need to actually increase this expense account because we're spending more money in that expense account, if that makes sense, right? So every time that we have another rent expense, we will debit rent expense. It just keeps going up and up and up. So let's type in rent expense, and we are going to debit it. The normal balance on rent, any kind of expense, is going to be debit. And then what's going to happen to cash? Well, it's going to go down. So we need to credit it, 650. Let's put in our document number. That's going to be C4. Transaction number 13, it says receive cash from sales. All right. Well, I know I'm receiving cash. That's the first thing. Okay. So if I receive cash and it's 2,500, let's put that in there right away. Next, I know that I have a sale here. So what's this account going to be under? Revenue. And what is it called? It's just called sales. Okay. And a sales account has a normal credit balance. Okay. So if we increase the sales account, it's showing that we have more sales. And that's just exactly what we're going to do here. So sales will be credited 2,500. We're going to put in our source document, which is the calculator tape. So it's T13. And we're moving on. So for 14, we sold services on account to K Spa. So here, what we have is two different accounts, right? And when we sell services, it's on account, it's still going to be a sale, okay? So what's the other account? Let's go into our chart of account, and we sold something on account. That's actually going to be an accounts receivable. So that's what it is here, accounts receivable K Spa. Got to be able to spell it, right? And let's just see how exactly they write it out. So it's a dash. I think that's how they had it. They got a space. Just want to make sure that it's correct. That should work. All right, and that's going to be debited as our asset, and it's going up because we know that K-Spa is going to pay us back that 480. And then this is a sale as well. So let's increase sales on the credit side. And this is going to be S1. Next, on the 19th, we paid cash for an electric bill. So once again, we have an expense. Electric bills are usually going to be referred to as a utilities expense. And a utilities expense has a normal debit balance. So we need to increase this expense. So it's going to be listed first because we need to increase that expense and we need to debit it. So it's going to be $220. And we paid cash for this. So cash is going to go down. It's going to be credited $220. And we put in the source document C5. Next, for number 20, it says received cash on account. It's now receiving cash on account from K-Spa who owed us that money before. So I know right away if I receive cash, cash is going to be listed first. I can always just tell that, right? Because cash must be debited if we receive it. Next, we have our accounts receivable from K-Spa. Put that in. And now that accounts receivable needs to go down because K-Spa owes us less money because they just paid us. And our source document is R2. Last one that we have is paid cash to owner as withdrawal of equity of $1,500. So let's go to our chart of accounts. When we have a withdraw, it's going to be called the owner's name and then drawing. Okay, so Norma Dirks drawing. Let's write that in. And a drawing account has a normal debit balance. So the drawing account is recording every time that we take out money as an owner. So if I take out money twice as an owner, that account just keeps on keeps on increasing and increasing and increasing. So now with somebody taking out money, is the drawing account increasing or decreasing? It's increasing. We must debit our drawing account, which is the normal balance. Drawing as a normal debit balance, so we increase it on the debit side. So $1,500, and then what's happening to our cash? It's going to get credited. And you might be able to look at this and go, hey, I know cash is going down, so drawing must, I know cash is going down and it's got to be credited, so drawing must be debited. Now that's okay. This is an okay way to think for a little bit, but we really want to remember what the normal balance of drawing is, okay? So challenge yourself on that. Let's hit save and continue here. And what we're going to do is we're just going to kind of move forward here and submit it without doing the second half like we normally do, just making sure everything's correct. The application problem for 3.3 is the exact same. It's just a little bit longer. So I'm not going to open that up for you, but I do expect you to complete it. So there we go, 3.3, 3 out of 3 for section 3.3, and we are good to go. So make sure you do the work together on your own and the application. If you have any questions, please let me know.